I want to be completely transparent. I want to show you my entire portfolio. I'm not gonna go fully into detail. I'm gonna quickly just explain you what the company does, what my investment thesis is, and what my stock price target is. My smallest position is in Asberry. I made a video on that already. Asberry is a dealership which also services cars and insures them. It had phenomenal growth lately due to a few big acquisitions and buys back a lot of shares usually if they don't do these big acquisitions. Their free cash flow is very volatile. Overall, their earnings per share multiple is right now very low, and they don't have too much debt on their book. That's why I expect them to keep acquiring new dealerships. They already announced their next big acquisition, which is gonna drive revenue even higher. My price target right now is 299 a share, which is a 57% discount to what the stock is trading at right now. So that is why I'm fairly confident in building up this position in this company. My next position is Petrobras, the Brazilian state-owned oil company. Petrobras is of course an oil company, so earnings will be very volatile, but they're still growing. They just recently announced oil outputs, and they're still growing production by a lot. Overall, free cash flow is more stable than at other big oil companies. That's why I like this company also a lot. Their price to free cash flow has been very suppressed since 2020, and I think the discount due to it being state controlled is way too high. That is my investment thesis here. My price target is 20.97 a share, which is fairly conservative. That gives a 35% discount. My next position is Vonovia. Vonovia owns a lot of real estate in Germany, Sweden and Austria, and is the biggest residential real estate company in Germany. They own a lot of buildings which are renting out at very cheap rates, so they have a very low vacancy and they have organic rent growth of usually 3 to 5% per year. Like other real estate companies, ever since interest rates have gone up, the stock price has gone way down. Even if everything goes wrong for the company and free cash flow basically nearly disappears, growth rates go back to very low levels, even then I will make a return on the stock. This is why I'm still holding a big position, even though the stock rallied quite a bit from when I held it. I think I'm up like 30% right now, so I'm still gonna hold it for a bit, but probably once interest rates start dropping and the stock will recover, I will probably sell it. The next stock is Medical Properties. Medical Properties has a bunch of hospitals which they rent out. Like Vonovia, it has been very destroyed after interest rates went up. And because Medical Properties also has some issues with tenants. People were worried that the tenants would maybe go bankrupt and they wouldn't be able to pay rent. I already made a video on it and why I think they will be able to refinance those loans and that the tenant situation is slowly improving. I built up a position first after the crash here to 810 and have been adding all the way down here. I'm probably going to add a bit more to the position. I don't want to make it such a big position, because there's still a bit of risk here. At these prices, even if free cash flow basically more than halves, growth rates stay low, and the dividend stays suppressed, I would still make a very decent return on the stock. I don't think it will recover to where it was in 2020, but right now, the risk that the stock carries is way worth it to me to buy the stock. Now comes the first stock where I didn't make a video on yet, Amsterdam Commodities. Amsterdam Commodities trades nuts, spices, tea, all of that. They don't grow it themselves, but they buy it and sell it. It's a very niche business where there's not a lot of competition. They usually have very slow growth here, and then every few years they make a big acquisition, like they made in 2021. Then they pay down their debt, and once their leverage is lower, they buy a new company. That is how this company grows over time. They're a slow grower, around 5% usually per year, but it's a very safe business. I expect the fair value to be at around 28.44. That will be a 44% discount for me right now. Next one is BTI, the tobacco company. A company with a very low growth profile. Of course, it's tobacco, it doesn't have much growth, but they're diversifying away into new product categories and they're soon going to be profitable. Those ones will have around the same margins of cigarettes and they will not be as harshly regulated. Overall, the free cash flow is just amazing and fairly stable, too slowly growing. They're not too highly leveraged and are slowly deleveraging, so they will be able to make acquisitions or buy back shares. Even if slow growth continues and they make no big acquisitions, only maybe buy back shares or have profitability growth in the new categories, the stock is worth around $58 for me, which is a 72% upside from where it is right now. The next one is a stock where I also didn't make a video on. It's Airtel Africa. Airtel Africa, as the name suggests, operates in Africa. While their revenue last quarter has grown very slow at 2.3%, that's because the Naira devalued by a lot, had a 50% devaluation. That's why this is a one-off result. On constant currency, they would have grown 20%. They make a lot of cash flow and are still trading at very low multiples. They make money from voice revenue, data revenue, and what is also specific to Africa, mobile money, so banking via your phone, and that is very fast growing in Africa. 25% reported currency growth. That's why I like this company a lot. It is fairly risky because, you know, it is in Africa. Coups can happen in many of these countries where they operate, but there's a lot of growth prospects. A lot of people are not connected to the internet yet, so they have a lot of future growth ahead. 9% customer growth in telecommunication, you don't find that anywhere else. Even if growth ahead is way lower and they only pay out a bit in dividends, the multiple right now is so low because the stock is seen as very, very risky. It is not as risky as it seems due to it not operating in only one country but all over the continent. This is why I think it will be one of the best performing stocks in my portfolio over the long term. My second biggest stock is CVS Health. The company is just on a revenue growth streak and is just beating competitors. Their business model is just way superior. They do not only offer the pharmacy, they offer health insurance, they offer pharmacy services, and overall the stock has been beaten down from its highs in 2022 and is now sitting at a price where I'm willing to buy it. The company is spitting out free cash flow every year and is also paying down a lot of debt. They had a few big acquisitions here, this is why the net debt went up, but other than that, usually they're paying down a lot of debt. So that's why I think even if free cash flow drops by like 20% in my assumptions here, and growth continues to be lower, I think it will still be a great investment. My intrinsic value would be $122, there will be an 81% discount, this is why I like the stock that much. It is a very, very low risk stock, but with a lot of upside. My last stock I hold is American Express. American Express is the luxury credit card company. They offer very high fee credit cards, which give you a lot of services. That is why it's usually more popular with higher income people, and that is also why I like the stock a lot. It has a very robust customer base who sees the card as luxury. The stock has been moved nowhere since 2021, despite revenue still growing and the amount of card members also increasing as well. They are using their gigantic amount of free cash flow to deleverage the business right now. We can see they have paid down a lot of debt, basically 40 billion since before the start of the pandemic. And once that is over, that cash will all go to the shareholders. And that on a $100 billion market cap, that is a lot of money. That is why I believe even if growth is going to be lower ahead, it is still gonna be an attractive investment. Amex has been around for centuries and is still developing, still growing. Its customers love the card and are willing to pay the high fees. That is also probably why Warren Buffett owns it, but I didn't buy the stock because he bought it. My intrinsic value is $265, which is an 87% discount. Do you own any of these stocks? Which one of these would you rather sell? Which one of these would you rather add to? Write it down below. Thank you for watching, have a good day.